Hey, Saretsky here. As always, Canadian normal stock market update with particular focus on Vancouver. If you're getting sort of value entertainment out of these videos, all I ask you a thumbs up and subscribe. Questions, comments, put those below. We got some great data today on the June housing figures across parts of Canada, rental data, and of course an update on central bank policy. So I kind of want to get into that, put the whole picture together for you guys again, because this channel has really always been about basically just updating you and helping you navigate the Canadian housing market. We don't share a particular view. We're not permanently bullish or permanently bearish. Like some people that have been calling, for a crash for the last 10 years and missed the largest part of the upside. I think that we successfully called the largest housing bull market in Canada's history over the past 2 years, and I think we've successfully called the pivot back in February. And so we're kind of just continuing to look at the data and looking at central bank rhetoric to get an idea of what's to come and to try to successfully navigate moving forward. So one of the things I'm looking at here again is central bank policy. We've talked about this over the last several months, is that the only way that central banks can meaningfully get inflation down from basically 30 to 40-year highs in inflation is not going to be through supply chains. It's going to be through killing demand. And the only way that they can do that is thus by raising interest rates, inducing a recession, and then hopefully killing enough demand to bring inflation down. And I think, again, this is not some sort of conspiracy theory. We actually had an update from the world's most powerful and most important central bank, Fed Chair Jay Powell, this week. So let's link to Jay Powell's comments right here.
The U.S. economy is actually in pretty strong shape. So if you look back a year, the U.S. economy grew more than 5.5%. It was really the big reopening year. And so we had expected this year to be that growth would moderate to a more sustainable path. Our focus is very intensely on setting policy in order to get inflation down to 2%. The way to do that is to slow down growth, ideally keep it positive, and as I mentioned, supply and demand get back into balance. So that's what we're trying to accomplish. Is there a risk that we would go too far? Certainly there's a risk. But I wouldn't agree that it's the biggest risk to the economy. I think that, the bigger mistake to make, let's put it that way, would be to fail to restore price stability. The war in Ukraine, which has added tremendously to inflationary pressures around food and energy commodities and agricultural chemicals and industrial chemicals and things like that. So it's gotten harder. The pathways have gotten narrower.
So again, similar to what Jay Powell is talking about, is basically that sort of soft landing is basically narrowing. It's becoming more and more increasingly difficult. And I think if you go back into central bank lingo over the years, I don't think there's really been a whole lot of evidence towards central bank soft landings. Once they begin these rate hike tightening cycles, there's been very few soft landings in the past. And so again, it's no different in the US than it is here in Canada. If you look at what our central banks are doing, which is they typically basically follow the Fed, you've got inflation right now running at 39-year highs. If we take a pivot and we go look at what's happening in shelter inflation, that's now picking up. So shelter CPI inflation is running at 7.4% year over year in the month of May. And so despite what's happening in the housing resale market, you've actually got a rental market that is continuing to heat up. So there really isn't nowhere to hide. I mean, you go and sell and you go and rent, and then you're faced with an incredibly tight rental market and extremely fast rising rents. Or again, maybe you've been locked out of the housing market and you've been renting for the last 5 or 10 years. And again, if your landlord's selling and you're seeing those turnover rents at the new prevailing market rents, they are extreme. So if we look at the rent growth from a national perspective, this is across the country. So if we look at one-bedroom rent growth across Canada, leading the charge, number one rent growth year over year in May. Calgary leading the country at 15.2% year-over-year rent growth. Victoria at 15%. Vancouver at 14.9%. Halifax 12.8%. And Toronto 11.1% year-over-year. That leads the top 5 across Canada. And so you have to look at this and say, okay, well, I mean, how much of rent growth, again, is due to mismanagement on the monetary and the fiscal side? Ironically enough, is we actually had some comments here this week from Canada's Minister Freeland, the finance minister. Let's link to Krista Freeland's comments right here.
What are your thoughts right now about a recession? I realize you met with Janet Yellen, and there was more talk about the possibility of a recession in the United States than here. She is now saying that it is not inevitable. What are you concerned about in terms of the likelihood of even a small recession in this country?
Another great question. I did meet with Janet Yellen less than a week ago. I've been talking with a lot of Canadian economists. I spoke to Larry Summers the other day. I think it's very important to be humble when it comes to making economic forecasts right now. We're in a very volatile, uncertain time with factors like the war in Ukraine, which are far beyond the remit of economic forecasting. Having said that, I think that a soft landing is absolutely possible for Canada. And I actually think of all countries in the G7, I would say of all the world's industrialized economies, Canada has a better chance of accomplishing this soft landing coming out of the COVID recession than any other country I can think of.
Just quickly, what do you say to Canadians who are, planning summer vacations, maybe won't be able to go as far as they liked, and are just struggling right now, and who may be directing some of that frustration, rightly or wrongly, at you and your government? What do you say to them, Minister?
I say it's okay to be mad. It's okay to be mad at me. I really understand that this is an incredibly challenging economic time. It's really, really hard for a lot of people. You talked about vacations, Rosie, and I think actually what makes it especially hard is a lot of people were looking forward to this summer as the kind of final moment of relief after COVID. Lots of people are getting married. They haven't seen their parents or grandparents for a long time. And then to have this high inflation environment, it is really awful.
So ironically, Krista Freeland, again, is kind of hoping for this magical soft landing, similar to Jay Powell talking about these soft landings. Notice that every central bank and policymakers coming out about soft landing. Again, these guys are really in a tough spot when you have all-time record high debt and you get stuck with an inflationary problem. And the only way to really fight inflation, if you're serious about fighting inflation, again, is to meaningfully raise interest rates. And so ironically, we're now stuck with a situation where governments all over the world are starting to panic. They're trying to stay in power. Again, governments, ultimately they're supposed to be working for the people, but they ultimately are working for themselves to stay in power and get reelected. And so nobody wants to actually do the difficult thing, which is to enact a situation where you have to have fiscal prudence. You have to basically have a level of austerity to get rid of inflation. So now when you look at Canada and say, okay, we're dealing with rapidly rising rent prices and an extreme unaffordability in the housing market. And so the central bank here is aggressively raising interest rates to bring inflation down. And what is the federal government doing? On the flip side, you had Krista Freeland and the federal government announce an $8.9 billion spending spree in order to fight inflation, and they are calling it an affordability plan. Yes, that's exactly what they're calling it. They're calling it an affordability plan. And in fact, one of those policy measures is to give a one-time $500 payment to 1 million Canadian renters who are obviously facing the wrath of rapidly rising rent prices. So again, nowhere to hide, whether you're a homeowner or a renter, you're getting squeezed in every single direction. But again, if you hand out $8.9 billion and you start giving checks in the mail to renters, that's not going to help the renters. That's actually, in my opinion, is a subsidy to the landlords. Basically that check ultimately ends up back in the landlord's pocket. So it's kind of rather ironic, and it actually is quite interesting when you have a major Canadian bank, because keep in mind, major Canadian banks tend to typically toe the party line. So there's a note this week from Scotiabank where they're basically saying, quote, "It is fair to say that fiscal policy authorities in Canada are doing nothing of any significance to slow inflation." And they're saying a 2.3% reduction in government consumption, aka spending, is equivalent to a 75 basis point reduction in the peak policy rate. So what they're saying is that if the federal government can just stop spending money, at least at the current pace, if they can reduce spending by even 2.3%, that will mean that Bank of Canada won't have to raise interest rates as high. So their peak policy rate, which I think we're pegging at about 3.5% on overnight rate, they're saying you wouldn't have to go up to 3.5. You'd be able to reduce that by about 75 basis points if the federal government can reduce spending. But in fact, they're actually doing the opposite. So you've got the Bank of Canada and Jay Powell and all these central bankers aggressively raising interest rates. And then on the flip side, you're seeing all these governments, not just in Canada where they're handing money to renters, but we're seeing this in places like California where they're handing people money for gasoline and they're handing people money for their rent checks. And so we're in a very precarious situation. And so now where central banks are having to aggressively raise rates, the markets are finally pricing in a significant growth slowdown. We're starting to see that in a lot of the economic data that is coming through, is you're seeing growth now materially slowing down, and markets are now pricing that. And you see, all you get to do, again, we talked about this, the most important bond metric in Canada is the Canada 5-year government bond yield, is watching that for any signals, because that's basically brought that Canada 5-year bond prices our 5-year mortgage rates. And we've seen that obviously the 5-year mortgage rates go from 2% at the start of the year to 5% today. You're now seeing that Canada 5-year bond actually has peaked and is rolling over despite inflationary numbers still poking higher. So this is basically the markets now pricing in a growth slowdown, where growth slows down and you get into basically recessionary conditions. And so I would argue that we're getting closer and closer to those recessionary conditions, because all you have to do, again, people get so frustrated about the housing market in Canada. All I can say is, whether you like housing or you're long housing or you're short housing, everyone can unanimously agree that housing is the economy. And that's not just in Canada, that's a large part in the US as well. Keep in mind that in Canada, over the last 5 years, housing, investment, and consumption, which are basically one and the same, because when your house goes up and you got to transact new housing, you go out and you buy a couch and you buy a new car and you buy all these, you do a home renovation. They are one and the same thing. Housing, investment, and consumption has accounted for 85% of real GDP growth in Canada over the past 5 years. And so when housing activity grinds to a halt, like it is, that will ultimately tip us closer and closer to those recessionary conditions. So let's look at the housing figures that we've got here for the month of June. The GTA, Greater Toronto Area, pulling in back-to-back months, so not only in May, but again here in June, a 20-year low in home sales in the GTA, a 20-year low in home sales in the GTA. Again, keep in mind that's Canada's largest housing market, largest metro housing market. And then in Greater Vancouver, we had home sales. They recorded their second weakest month of June in over 20 years. Second weakest month of June in over 20 years. If you go into the suburbs, where again I think you're seeing most of that decline, where most of the froth was the pandemic trades, similar to like big tech, all the names like Zoom and Peloton, anything that did well during the pandemic. I mean, that was suburban housing, is now coming off rather significantly. In the suburbs, home sales in the Fraser Valley here are off 47% year over year, the slowest month of June since the year 2000. That's a 22-year low in Fraser Valley home sales. Now, keep in mind, the Fraser Valley, in terms of population and housing stock and migration, has grown tremendously over the last 22 years. So to put that into context, to have a 22-year low in home sales in the Fraser Valley is pretty ugly. And so, those are kind of what I'm thinking and kind of what I'm watching. Now, keep in mind, you're still not seeing that flood of new listings, right? Just because rates are up, people are not panicking. In fact, new listings are actually down year over year in a large part of these markets, but inventory is sitting longer, and so it's slowly accumulating. And obviously, we're seeing the downwards pressure in large parts of these markets. So that's kind of what I'm watching for here moving forward. is, again, we talked about this, guys. This was well in advance. Anyone that's been following this channel, reading my reports, we're doing our best. We're certainly not going to get every call right, but one of the things I talked about was all you had to do when we started to see rates move, earlier in basically in March. I said, well, let's watch this, because rates were creeping up to 3.5 into 4, and I said, hey, hold on a minute. All you had to do is go back into 2018 when mortgage rates hit 3.5, 3.6%. Everybody thought they were going to 4%. Housing activity thus slowed because everybody thought, again, that rates were going to 4%, so they should wait. Housing activity in the GTA fell to a 10-year low, and we had an 18-year low in home sales in Greater Vancouver for the year, not just for a month or two, for the year. And so now that you have mortgage rates again in the fives, it doesn't, it's just math. Like, these two housing markets are built on a lot of leverage. They aren't designed to withstand 5%, 6% mortgage rates. So that's kind of where we're watching. But I think the bond market is now going to do the job of the central banks, which is it's now pricing in that recession. So you're seeing yields coming off. So I think you'll see some easing in longer term 5-year fixed mortgages. So as always, hope that helped. See you next week.